Keynes, Part 2. The trick to understanding most of these theories, again, I've mentioned this before, is how savings and investment come together. Remember the circular flow, visualize in your mind, and know that savings and investment there in the middle are really important. So remember, factories, trucks, planes, machines, all that stuff is capital. The process of buying those factories, trucks, planes, machines is called investment. If you think, let's be clear again, you think, or many people think, you don't think that anymore because you're an econ student, but many people think that, hey, I took some money and I bought a share of stock in the stock market, I'm investing. No, you're saving. You took some of your income, you didn't spend it, you saved. Investment is when we buy capital, okay, which most people don't do very often. Maybe their house would be an exception. The key, the thing that Keynes is going to remind us of, and lots of other people did too, don't, at some point in your life as a new-bound econ major, you're going to go take history of economic thought. And then you'll learn that, lots of people said this, but the thing that Keynes is going to do to us, to break us really from the classicals and say, is to remind us that investment is something that happens over time. When United Airlines buys an airplane, they're going to expect that fly that airplane for 20 years. It's not going to make them back the payment instantly. That aircraft is going to have to be useful for them for 20 years. When we spend $2 billion to build a brand new hotel on the Las Vegas Strip, that hotel is going to be there 20, 30, 40, 50 years, maybe longer. It's going to take 10 years, 20 years before they can pay back the money that they spent to put it in. So we're going to evaluate these investments over time. We usually have to borrow the money to do a big investment. We usually have $2 billion sitting around. United might not have a couple $100 million sitting around to buy another airplane. So we're going to borrow that money from people, and then we're going to pay them back. That means that both the lenders and the borrowers have to believe, they have to have faith, they have to believe that the business is going to prosper for those 20 years so that everybody can make money. We have to have a vision of the future that says we can pay this back. So what Keynes does is he throws this word expectations at us. Yes, interest rates matter. Businesses are going to invest more when interest rates are low and less when interest rates are high. But that's of secondary importance. The primary thing that's going to drive investment for us is the expectations of business people, what the lenders and the borrowers see out into the future. Look out into the future, what's going to happen? Your view of the future in 1930 is way different than your view of the future in 1990. Way different. So even if interest rates are exactly the same at those moments in time, your expectations aren't, and people's willingness to invest won't be. Are people smart? Keynes thinks that people are stupid, that they follow the crowd, that one of them jumps off the cliff and all of the rest of them go with them. Keynes says, hey, there's a couple of smart people and everybody else just follows along. Keynes has a word for this, a phrase, actually 2 words, it's a phrase, but a word for this. And that word is animal spirits. Not spirit animals, not animal instincts, animal spirits. If you read the financial press or watch CNBC or Fox, people throw this phrase around all the time. People who don't like Keynes because they've never read him throw this phrase around, probably without even realizing that it comes from Keynes. People are driven by their animal spirits. They follow the crowd. They run with the herd. Something happens and the whole school of fish just turns and runs off, even though they don't actually, most of them don't have any idea what just happened. They're running. If the economy is built on animal spirits, if it's built on herd behavior and people just acting without necessarily knowing anything, they just saw two people run and they all had to run with them, things are not going to be stable. The economy is simply not going to be stable. So Keynes talks a lot about confidence, that the economy depends on confidence. It depends on there being a state of expectation, the state of the world, which the average business person sees as positive. Keynes talks a lot about the need for people to believe, for them to see goodness in the future, for them to have confidence in the economy. A lack of confidence can cause a crisis, and a lack of confidence can prevent us from ending a crisis. So again, if Keynes is right, savings is a function of consumption, investment is a function of expectations, interest rates play a role in both of those, but are not the determining factor. So what's the key here? Savings is not going to equal investment. Interest rates, by the way, are going to be determined by the supply and demand for money, not just savings and investment, but all the uses of money will determine the demand for money, and the supply of money in general, not just the money that goes into investment, but the supply of money in general. Those two things are going to be supply and demand. Bigger picture, interest rates are going to equate the supply and demand for money, which might not equate the supply and demand for investment. And by the way, a little hint there, the government controls the money supply, which means if Keynes is right, the government controls interest rates. Okay, so some things that Keynes believes. Keynes believes that you do care about your nominal wage, not just your real wage. When your boss comes to you and says, look, I've been paying you 10 an hour, I want to pay you 8, and you know prices are going down, you still are going to be pissed about it. And it's going to affect you, and it's going to affect your behavior. 2, Keynes says expectations. We're not just looking at today, we're looking out into the future, and that matters. 3, there's a spending multiplier. Spending matters, and one person's spending is the next person's income. So $100, $1,000, $1 billion that changes at the beginning is going to end up being more than that dollar or $100, $1 billion by the end. And Keynes says it's important to include financial markets in our models of the world, that financial markets can't just be assumed to be perfect, that there's going to be problems in financial markets, and those are going to create problems for the whole economy. So what exactly does he say about financial markets? Well, he says that financial markets are like a casino. They're a game of chance. They're a game of snap. There's apparently British card games and things that we Americans don't know about. But financial markets are like a casino. The stock market's more like a casino than it is about anything else. He talks about the fact, and remember that Keynes's first book was a probability book. What he talks about is the fact that we need to assign, if you look at theories of finance, they generally say you have to be able to assign probabilities to outcomes. Well, Keynes says, look, a lot of times we can't assign a probability to an outcome. And when we can't do that, all of our theories fall apart, all the world falls apart, and until we get somewhere where we can assign these things, it's going to be wrong. In our terms, we develop these models of the economy, these big equation systems of how things are supposed to work. And those equations have parameters. They have numbers, y equals 6x. Well, what happens if that 6 is a 6 one day, and it's a 3 the next day, and it's a -2 the day after that, and it's... Keynes does not believe that these equations that you could develop, any equations you could develop of the economy, are going to be consistent over time. They're going to change, and they're going to change sharply and instantly. And we cannot keep up. And then finally, he talks about the fact that even in the 20s and 30s, most of the people playing the stock market are not playing the stock market for the long term. They're playing the stock market for the short term. In Keynes's era, it was a day or two. In our modern era, it's seconds or minutes at most. Most of the money that flows through the stock market today, just like most of the money that flew through the stock market in the 20s, is not there because they want to hold on to that and make money over time by investing in a company. That money in the stock market for them to make a quick buck as its price goes up and down. That speculation is occasionally going to cause an economic crisis. It's going to cause a big problem in Keynes's world. And strangely enough, if you actually go back and read the classical economists, they will tell you exactly the same thing. They won't have the formula that Keynes has, the whole structure that Keynes has. But if you go read John Stuart Mill, for example, who is the last of the original classicals, essentially middle of the 1800s, he says, hey, recessions happen because speculators go in and screw up the financial markets. Okay. That seems to disappear from modern versions of classical economics. Now, remember that classical economists were thinking about the long run, right? They said, look, what really matters is getting out to that future, getting out to that great period that's going to come in the future, and we should be less concerned about the present and more concerned about keeping conditions right for long term. Keynes says that's like being the advisor to the captain of a boat, and you're in the middle of a hurricane, and the boat's taking on water and starting to get lower and lower in the water because it's full of water, and it might be about to sink, and the captain says, what do I do? And you say, don't worry about it, the hurricane will leave soon. Keynes says it's silly. Keynes says you've got to tell the captain to grab a bucket and start bailing the water out of the boat. So he gives this comparison where the classical economists are people who take a chance that the boat's going to sink because they know they don't have to worry about the present, they're only worried about the future. Keynes then follows that by saying, in the long run, we are all dead. It's a great line. It's my favorite economics quote of all time. In the long run, we are all dead. Keynes says you got to bail the water out of the boat. You got to fix the economy now. You can't just sit around and wait, because look at the Great Depression, 12 years. And if World War II doesn't come, how long is the Great Depression? You can't wait, in Keynes's view. You have to do something. You have to be active in the present. Dead. We are all dead. So, Keynesian economics goes to the point that Richard Nixon, when he's president of the United States, literally says, aren't we all Keynesians now? The problem is we're going to get to the 70s, and just like classical economics bumped into a wall it couldn't explain, things are going to happen in the 1970s that the Keynesians really can't fit comfortably into what they're talking about, and we need to do something else. So we're going to talk now about that something else.